like?
Today we're looking at an investment analysis report arguing NVIDIA is kicking off a massive Blackwell supercycle.
And that this cycle is projected to drive the stock toward a $250 consensus target. So, right off the bat, a key theme running through this material seems to be the compelling quantitative evidence. It's all supporting this immediate and massive demand for NVIDIA's new Blackwell architecture.
You really established the scale and the urgency of the catalyst here.
It's very clearly laid out. I mean, the analysis does an excellent job establishing the magnitude of this generational catalyst.
The numbers are just
huge.
Specifically noting the leap to 208 billion transistors, the sheer size of that projected $500 billion backlog pipeline through 2026.
And that Q4 revenue guide? $65 billion.
Incredible. But what truly anchors this thesis, I think, is the profitability. That rock-solid financial foundation, those sustained 75% gross margins. That's very well articulated.
And it's the core reason the market gives it such a premium valuation.
Exactly.
I agree. The immediate case is robust. The numbers are, frankly, overwhelming. But if the goal is to maximize the impact of this report and really lean into that word supercycle, we need to focus on structural resilience.
Okay.
The analysis effectively establishes the immediate demand surge driven by the Blackwell launch, but the long-term robustness of the supercycle narrative could be strengthened by preemptively addressing competitive and structural dynamics.
That's a fundamentally critical point for any thesis that relies on a multi-year cycle.
Especially in this industry.
Right, especially in a hyper-competitive space like AI infrastructure. As I understand it from the notes, the argument here is that the demand is, well, their word is insane.
Yeah, insane. Fueled by the hyperscalers building out artificial general intelligence or AGI.
And that NVIDIA is basically the only game in town, the only viable supplier.
That's the crux of the bull case. They are dominating the supply of an immediate existential need for their biggest customers. The challenge, though, is that the analysis focuses so heavily on that dominance today. It implicitly assumes this structural scarcity, and by extension, the multi-year cycle is just going to persist, without deeply examining the counterarguments.
And the big one is the increasing incentive for the hyperscalers themselves, Microsoft, Google, Meta, to pivot toward internal chip development post-2026.
Exactly.
That assumption of prolonged dominance is precisely where the skepticism comes from. These customers have the capital, the engineers, and, the strategic incentive to vertically integrate.
Of course.
If they start building their own silicon in earnest, that directly threatens the 75% gross margin structure that defines the stock's valuation.
And not addressing that leaves a pretty significant logical gap. It doesn't fully insulate the long-term supercycle theses from that risk of future revenue substitution.
So to make this analysis truly bulletproof, we need to anticipate and neutralize that skepticism.
Right.
And we're not suggesting a full, a bloated competitive analysis.
No, that would bog it down.
We just need to show why, even with these internal efforts, the supercycle persists, or at least why its core profitability can be defended. So the suggestion is to integrate a brief, forward-looking counter-argument section. Maybe a sensitivity analysis on how resilient that $500 billion pipeline really is against these threats.
Specifically vertical integration. But isn't it hard to credibly dismiss efforts by trillion-dollar companies without just speculating?
It is difficult, but we can stick to observable technical facts. You don't have to debate every custom silicon project.
Okay.
You just need to show why Blackwell is, right now, and will remain for the foreseeable future, indispensable.
That's highly actionable. One way to do that would be to briefly explore the current limitations of those internal chip projects.
Right. They face enormous hurdles. Things like the difficulty of scaling production to meet global AGI demand.
Or ensuring seamless software ecosystem compatibility. That's a huge one.
It is, and just meeting the raw performance metrics.
And that last point is key. The report cites Blackwell's incredible speeds, 4x training and 30x inference improvement over the last gen.
You use that contrast to define the moat. Show that while the hyperscalers might chip away at some inference workloads, replacing Blackwell for state-of-the-art AGI training, the main driver of the supercycle,
is not a simple lift.
Not at all.
That's a tangible way to make the defense concrete.
Another concrete approach could be to estimate the minimum market share NVIDIA has to keep in that AGI training space, say in 2027.
To justify maintaining those 75% gross margins?
Exactly. Providing a measurable metric for the robustness of the supercycle shifts the discussion from simple demand to sustained structural necessity.
It turns that implicit assumption of dominance into a defined, monitorable threshold.
Right. If you can credibly argue that even with 20% internal competition, NVIDIA still keeps 80% of the training market because of its ecosystem and performance,
Then the supercycle thesis holds water.
perfect. It moves from just stating the bull case to defining the critical defense parameters of the thesis.
All right, moving on to our second major area of opportunity. While key risks are appropriately identified, quantifying the potential financial impact of these constraints and integrating them into the valuation context would enhance the analysis's overall risk-reward assessment.
That's crucial because the analysis is so quantitatively focused on the upside, it only makes sense to hold the downside to that same rigorous standard. They're acknowledged, which is, a necessary first step.
Acknowledged, yes, but not integrated into the model. The listed risks, the threat from TSMC, the impact on that roughly 10% revenue stream from China, they're just presented as qualitative bullet points.
Almost like footnotes at the end of the report, rather than integrated variables in the forecast itself.
And that's a common pitfall. You separate the bullish projections, like that $65 billion Q4 number, from the stress testing that's needed to make sure the analysis is robust.
Which means you're really just presenting a best-case scenario.
Exactly. And the investor is left to just guess what a significant external shock might actually do to the numbers. Precisely. If we're arguing for a $250 target, we have to define the financial floor.
But isn't it fundamentally difficult to put a precise dollar figure on something like geopolitical risk or on the reliability of TSMC capacity, which is, notoriously opaque?
We don't need perfect precision, but we do need defined scenarios. The suggestion here is to calibrate the probability or the expected financial impact of those two main risks against the aggressive forecasts.
Okay, so the investor understands how the thesis holds up under specific adverse conditions.
It elevates the analysis from a bullish report to a comprehensive risk management framework.
Let's make this concrete. To illustrate the supply chain threat, the report could detail a, say, low-probability, high-impact scenario.
Like TSMC constraints limiting Q4 revenue not to $65 billion, but to, let's say, $60 billion.
A $5 billion near-term miss. And then you explain what that specific miss might do to the immediate stock consolidation.
Which the report correctly identifies in that critical $180, $185 range. Does it briefly break support? Does it consolidate lower? Defining that impact shows the reader exactly where the short-term downside could be.
It anchors volatility to a measurable outcome. That's very useful. And for the China risk, the analysis says 10% of revenue is potentially impacted.
So you could calculate the precise annual EPS impact if that 10% is permanently eroded.
And then explicitly state how that negative outcome tests that strong institutional support level of 170, 175.
By defining the financial relationship between a calculated risk and a defined support level, the material becomes a much more compelling navigational tool.
It lets the investor know what risks are already priced in at various levels.
Exactly. It sharpens the quality of the discussion around the valuation floor.
It turns these abstract geopolitical risks into calculable financial consequences.
I like that. Okay, for our final critique, let's look at the angle and originality. The analysis provides a compelling entry point through its technical breakdown, but it could be used more aggressively to define a unique, tactical timing angle beyond simply compiling the general street consensus.
Okay, so what I really like about this part is the clear mapping of the current consolidation, that tight 180, 185 range.
Yes.
And the specific breakout level of 195 that technical analysts are watching. It shows the person who wrote this understands this isn't just a buy and hold thesis.
It's about timing and execution. But the issue is in the structure of the argument.
How so?
Well, Section 2 relies heavily on compiling the existing analyst consensus, citing Goldman at 250, KeyBank at 275.
Which validates the thesis.
It validates it, sure, but it makes the analysis less distinct. It's confirming the street rather than leading it.
And the powerful technical analysis in Section 4, the coiling action, the defined support, that critical breakout level, it's presented completely separately from the core financial thesis.
A huge missed opportunity. It could provide a unique, time-sensitive tactical edge.
If the technical setup is that precise, it should be the ignition switch, not a footnote.
Precisely. If the fundamentals are accelerating and the technicals are signaling an imminent break, those two concepts should be fused into one potent, urgent argument.
But wait, isn't that over-indexing on technicals? This is positioned as a fundamental analysis.
It is.
We could risk turning a solid research report into like a trading note that might undermine its credibility for long-term investors.
That's a fair point, but we can maintain the fundamental rigor while using the technicals as the strategic imperative.
Okay,
The suggestion is to weave that technical coiling action and the critical 195 breakout level directly into the primary investment argument. Argue that the combination of fundamental acceleration and tactical timing makes the current price an unusually time-sensitive opportunity.
That reframing changes the entire mandate of the report. It uses the technical trigger to command immediate action, rather than just confirming targets.
Right. You use the technical insight as the primary ignition switch for the whole thesis.
So, a concrete example would be to reframe the summary. Argue that the imminent technical trigger above 195 is the ignition point.
Yes, the thing that translates that confirmed $500 billion pipeline into rapid price discovery toward the high-end targets of 275, maybe even 300.
It makes the technical level critical to unlocking the upside, not just an interesting chart pattern.
And to maximize that urgency, you could use this timing mechanism to suggest that the consolidation at $182 isn't just an attractive entry point,
Which